Hi, so this is my reaction towards the bold claim of whether Alibaba is going to reach $510 in the near future. So essentially, this long-form content, which is a discussion between Marcel and Tom from Great Hill Capital, and he posted this video just recently on the 6th of October with the title Red Siren, a Mooning Stock Chart, Neo and Baba Investors Must Watch, is the bottom in? So of course, when you employ such language, it's a must watch. I must definitely show some support as well. And of course, don't forget to smash that like button like how I smashed this. Just kill the like button and make sure that it's turned on. Yeah, don't double click it. Oh, I have good news by the way. So Weebul has recently extended their latest sign-up bonus rewards of up to $130 worth of Tesla shares for new users until the 14th of October. So all you have to do is to sign up for a new account with the link below and deposit at least 2,000 Singapore dollars and execute one buy trade for a stock or ETF and one option. And you will get an 8% return on investment from the sign up rewards. So Weebul prides itself on zero commission trading. So let's stop paying all the different commissions and use it to buy more Alibaba. For existing users though, feel free to get your friends to sign up using your own referral code. You can refer and win up to $6,888 worth of Apple shares. Details will be on the promotion page itself. I'm currently using Weebul for my 15,000 portfolio challenge, so don't let this guaranteed deal get away. Link in the description below. So anyway, I think it's also an opportune time for us to compare notes and to see what are the different assertions and what are the different assumptions being baked into the stock price today and how you're able to benefit as an Alibaba or as a Neo shareholder. And I know for some of you who actually do follow me for quite some time now, I'm not as bullish on Neo compared to Alibaba because of a myriad of different reasons. But I guess that's the whole point of being an investor, right? Me being bullish on China doesn't mean that I'm bullish on the entire basket of all the different Tom, Dick and Harry companies out there. But anyway, I just wanted to focus specifically on a particular segment of the video where they were discussing about the valuations of Alibaba, and Tom was basically making some very bold claims around how Alibaba is going to reach $510. So let's watch it together.
Eastern Europe, and they're just going to dominate. And that's like just getting started. So leaving aside that the international is going to grow, the Chinese is going to rebound, forget the commerce business. Let's just assume that that's zero. And the current operating income, of which about right now, the total contribution of cloud to operating income is 180 million. Because at $11 billion of revenue, they have no scale. At 30 billion, they're going to have major scale and they're going to get that 29% operating margin. But the current operating income is 15.2. So if you add $10 billion of operating income to that, you're looking at 26 billion if you add it to last 12 months versus.
Oh dear, he's speaking at an exponential rate. So give me some time. I will have to sort out the notes. Okay, so these are basically some of his assumptions. And I won't be too quick to judge and to basically decompose this entire structure. I'll let him put forward his case first, and after he finished putting forth his case, then we'll start looking into the numbers.
Peak, pandemic peak, which was 16.7 billion. And what that means in English is this. You basically have 60% more operating income in 2025, just on the basis of the cloud growth, assuming nothing else grows, than you did at the peak when Alibaba's ADS was trading at $319 a share. To put that in perspective, we're trading at, $84, $85 a share today. And that assumes peak multiple. So if you apply the peak multiple that the market assigned when the stock was trading at 319 with the growth in cloud by 2025, you're looking at a $510 stock, assuming nothing else grows. Now let's just cut that in half and assume that we don't get a peak multiple, that we actually get a trough multiple, and no one ever becomes euphoric about Chinese stocks again, and they just give them the lowest historic multiple. You're looking at a $200 to $250 stock. And again, that assigns zero credit for the cash on the balance sheet, zero credit for owning a third of Ant Financial, which, by the way, was originally going to IPO at $300 billion. The business has grown in the interim, but maybe the market assigns $150 billion today because of the pessimism. At some time in the future, that business will be worth $500 billion to $1 trillion. That may be 8 or 10 years out. and as owners of Alibaba, you own a third. So when I do the sum of the parts, and I continue to just assign zero growth to the domestic and international e-commerce growth, which I think both of which are just starting in terms of recovery from zero COVID, in terms of pro-growth policies that have been aggressively in place since March, but not being felt in the economy due to the COVID zero that is now ending. And then you've got the China National Congress in a couple of weeks. And if you look at the people that Xi wants to run economic policy post-election, they're very pro-growth and pro-consumption. So, your upside case just on the cloud is, 510 with a full multiple, assuming nothing else grows. And downside case 250. The key is waiting through the short-term volatility and dealing with it and adding opportunistically when the market has its fits and emotional ups and downs. But I've not seen a business set up like this at this scale with this level of moat in my career. I've certainly seen special situations in the smaller mid cap that were many multi-baggers, and those are a little easier to find. But in terms of what Alibaba is offering today, I just continue to look at the valuation and even Marcel, before I sharpen my pencil on the cloud and what that means moving forward, I think I talked last time to your viewers. You basically have a business that's grown. The total business has grown revenues 800% since 2014. Earnings 500% since 2014, and you can buy it for less than 2014 prices, and no one wants it. And that's the beauty of the mania of Mr. Market, as Ben Graham taught us in The Intelligent Investor, serving up euphoric prices and despondent prices within a matter of months and years. And right now we're in the despondent prices phase, and you can't give them away. And I can assure you, whether it's 1, 2, or 3 years from now, we'll be back in the euphoric phase, and we'll be laying off our stock that we own in the low hundreds to people in probably the mid 400s and mid 300s, and maybe a few shares that we hold on to above 500. And that sounds like pie in the sky, but if you actually do the math, could something happen? Could you have you always have to assign small probabilities. Could you have a China-Taiwan conflict? Sure, you could have that, but everyone kind of knows that, and that's probably priced in here. Could you have a continuation of ridiculous a crackdown that had happened 12 months ago? You have it every 3 to 5 years. They do the same exact thing. Could it persist a little longer? Sure. I mean, this one has persisted longer than I had anticipated. But leaving that all aside, the business continues to grow. And, even though they work at it 24 hours a day, 7 days a week, they can't seem to kill it.
Fantastic. I love the long-term view there.
So I think I've given him enough airtime to make his case. So now we'll go right into the details of his numbers and whether are we comfortable with his many projections and assumptions or not. So now, I've transferred some of the notes that I've jotted down during the discussion previously into a Word document so that we can break it down carefully and to really see whether are there any merits to his discussion or whether he's pulling numbers out of thin air. So firstly, he's trying to strip away Alibaba's core businesses and to really just identify the main growth driver and the main growth engine in the coming 5 to 10 years. But now he's basically making the bold assumption that, hey, their e-commerce business, their finance business, their logistics business, all of them are not going to continue growing, even though they've experienced a great deal of growth for the last decade or so. So let's assume that all of them stagnate, and some might even lose their market share, because based on some estimates out there, some of them are expecting Alibaba to continuously lose market share. But let's just look at this cloud aspect. And currently, if you were to look at Alibaba's cloud business on a standalone basis, the cloud operating income of Ali Cloud is around $180 million at 11 billion revenue that they brought in. So for some perspective, because I know that there is some conversion issue and many of them are actually speaking in terms of USD, but maybe I'll just tag along the renminbi equivalent so that we are a little bit more accurate in terms of our projection. So for financial year 2022, Ali Cloud actually contributed to around 74 billion renminbi to the entire business. And FY 2022 actually represents April 2021 to March 2022. Don't ask me why it's so weird, but this is how they essentially do their accounting numbers. So out of 11 billion revenue, they only did 180 million in terms of operating income. And that's pretty lackluster if you were to ask me, especially if it's a cloud business. So what Tom is actually arguing for is this. At $11 billion revenue, Ali Cloud hasn't achieved scale. However, at 30 billion revenue, he is guessing or he is estimating that Ali Cloud is going to achieve that kind of scale. So at $30 billion revenue, he's saying that he's making an assumption of a 29% operating margin. So this means that at the top line, from 11 billion to 30 billion, they need to at least 3x from here. And at least on the bottom line, I think Ali Cloud just broke even. So I think the easiest comparison many investors out there try to make is to compare it with AWS, because AWS is currently the darling of Wall Street with an incredible amount of growth and also an incredible amount of margin compared to Amazon's commerce business that is at most 2 to 3%. So if you have to compare it to AWS's margin and growth and revenue, we can actually use a retrospective approach to see how much or how far AWS have matured and how much of an operating profit that they have managed to generate when they were at maybe 30 billion, 40 billion, 50 billion. So if you go back to 2018, AWS actually reached a scale of around 25.8 billion revenue, and they got 7.2 billion in operating profit. So that's actually a 28% margin. And in 2019, they actually reached a scale of around 35 billion revenue and a 9.2 billion operating profit, and that's a 26% margin. So currently, if you were to compare it on vanilla terms, even AWS reaching 20 to 30 billion in terms of revenue, they were not able to reach 29% operating margin. I don't know whether Ali Cloud will reach it or not, but I'm just stating the facts. However, that being said, if you were to look at AWS in 2021 and 2022, when there was this huge growth spurt, that was when Amazon's AWS operating margin actually shoot over 30%. So if you were to really ask me, at 29% operating margin, is it fair? Probably it's fair, but I think as investors, we want to be conservative. So maybe we shouldn't apply a 29% margin. Instead, some of you might want to apply 20%, 25%. I think it's up to you to decide. Valuation is more of an art than a science. So this is one part of the equation, looking at the margin itself. On the second part, now we have to ascertain whether they are able to 3x from here. So currently, Ali Cloud is doing 11 billion. It's the biggest in the entire cloud service provider industry. So then begs the question, do you believe that Ali Cloud can 3x from here? And whether the circular tailwind of the cloud industry in China alone is strong enough, and whether Alibaba can maintain its market share. So for some context, Ali Cloud is currently holding around 30% in terms of market share. So of course, as investors, we always want to take the conservative approach. So let's say Ali Cloud continues losing market share until maybe it holds only a quarter of the business. And understanding the tailwind of the cloud business as a whole, do you think China is able to replicate whatever the world is currently experiencing? Because we have to understand the different nuances when you're to compare Microsoft Azure, Amazon AWS with Alibaba's Ali Cloud and Tencent Cloud, for example. Because many of the product offerings and there are many security concerns, there are many geographical conflicts and people not trusting each other. So I think just speaking about the Chinese cloud market alone, at least from Alibaba's presentation, I think I'm going to attach it somewhere here. They actually make a prediction that from 2020 all the way to 2025, the expected cloud growth is going to reach $1 trillion renminbi in total addressable market. So if let's say Alibaba maintains the 25% market share, $1 trillion multiplied by 25%, that's $250 billion renminbi. And of course, if you were to compare the 250 billion renminbi to 74 billion, that's around 3.2 to 3.3x, if I'm not wrong. I'm just doing it at the back of my head, so do correct me if I'm wrong. So that's essentially our baseline assumption. Assuming Alibaba manages to hold their market share of 25% and their revenue will balloon to 250 billion renminbi. If a big if here, if you believe that China's cloud market will reach 1 trillion by 2025. And that's expectations from Alibaba's management team as well. There are definitely many different estimates out there, whether is it from consulting firms, whether is it from their own e-commerce counterparts as well. So I think you should take many of these estimates with a grain of salt. But I would believe that Alibaba's management team will know a thing or two, a lot more compared to people from the outside view. But I think the more critical question for many investors out there would be, given the slowdown in the last 2 years, especially because of the tech crackdown, because of the pandemic lockdowns, because of some sort of leadership transition, etc., would this pose as a major hurdle for the companies, the country, and by extension, the economy? And how quick would the rate of adoption be into the cloud market? I think these are all extremely big question marks So investors are essentially not confident for that happening so soon. And that is also kind of baked into the valuations of Alibaba today. So now, if you were to look into the bottom line and to look at how Alibaba and Ali Cloud has been performing thus far, the current adjusted EBITDA for cloud for FY 2022 is 1.146 billion renminbi. So that's around 160 million USD. And the total adjusted EBITDA in 2022 for the company itself, the Alibaba Group, is around 130 billion renminbi compared to 170 billion renminbi in 2021. So this huge drop will be explained later on when we talk about what's basically happening to provide more context rather than just to throw you numbers and to tell you that, oh, this is my projection and my assumption. So as the posting of the video, Tom actually claims that Alibaba's current operating income, or at least in its peak, it's around 15 to 16 billion US dollar, I presume. But if I were to actually extract the operating income figure from Alibaba's earnings report, I actually couldn't really find this 15 or 16 billion dollars that he's talking about. Probably because I was looking at it on a financial year basis. So this is for FY 2021, this is for FY 2022. I'm not looking at a peak because if I'm not wrong, the peak figure for Alibaba EPS operating income was in between two financial years. So that was probably how he derived 16 billion. But if you were to look at the trend for FY 21, Alibaba's operating income was around 89.6 billion renminbi and 2022 was around 69.6 billion renminbi, and that converts to around 12.5 and 9.73 billion. And this is of course based on today's exchange rate, and as you know, the USD has strengthened crazily over the entire basket of other currencies, renminbi included. But anyway, if you were to compare it to the trailing 12-month peak net income, it was actually in December of 2019. And based on macro trends, December of 2019, it was actually at $9.37 per share. And this is of course based on USD conversion. And I'm not too sure whether the base effect is accounted for because of the currency appreciation, etc., etc. But yes, based on 2.66 billion shares outstanding, I think Alibaba's peak valuation was around 800 odd billion at $310 per share. So that's just some context for you as well. So based on the premise of Tom's discussion, let's assume that Alibaba manages to normalize its earnings and the operating income will balloon back to 15 or 16 billion. And let's say that the cloud continue growing at that kind of rate, it's going to 3x from here and it's going to achieve its 29% operating margin. That's actually an additional $10 billion because 30% you take 30 billion, that's 10 billion. So if you to compare 26 versus 16 billion of operating income by 2025, that's 60% more operating income. And at its peak multiple, back in mid of 2020, you are looking at $510 per share. And even at the lowest multiple, Alibaba is at least trading at around $200 to $250. So some of you might ask, what do I mean by peak multiple or lowest multiple? So now, if I were to just pull out Capital IQ, I think it's quite easy to kind of visualize what he means and what he means by peak multiple and trough multiples. So as we understand, I think back at $310 valuation, that's probably around September, October of 2020. That was when Alibaba was at peak valuation. So let's just take these two columns. So let's take one very simple metric. A lot of people like to talk about price to earnings, right? The PE ratio. So PE ratio has two different versions as well. One is last 12-month EPS, so that's the normal trailing PE ratio. And the second one is next 12-month EPS, which is forward PE. So just looking at these two benchmarks, looking at September to December, they were trading at around, on average, 31 to 35 times, and next 12 months is around 28 to 26 times. And at its highs, it was even around 42 times. At least 35, 33, 42 times. So will Chinese equities ever be able to revisit this kind of PE ratio of 30, 40 times? I don't know. I think it's up for the market to decide. But I was just saying, actually back in 2020, they were experiencing this sort of multiples. And if you were to look back into 2022, which is currently, last 12-month EPS, it has ballooned back up to 30 to 40 times, but that's because of the EPS collapse and there was some destruction in terms of net income. I will explain it in the later part of this video. But if you were to look at next 12-month EPS, which is forward PE, you can see that it's basically trading at 10 times, 9 times, sometimes even 8 times if it goes down to $70 again. So these are just some of the metrics in terms of peak valuation. And truth be told, I do agree. I think this is just basic mathematics because you're just applying a ratio to the underlying factor or the underlying assumption that you have. I think the bigger concern for many investors is really how confident are you that they're able to 3x from here for their cloud, and how confident are you that they are able to achieve such a strong operating margin? I think those are all existential questions for a company, especially like Alibaba. And more importantly, of course, he's going to slide in something like, oh, Alibaba's revenue has 8x, their income has 5x since 2014. And I think at the current valuation, it's trading lower than its 2014 share price. So I guess I'll leave it up to you to decide whether you think this company is undervalued or not. So one more important factor that he was talking about was also this idea of a China-Taiwan conflict, and it's quote-unquote priced in. Truth be told, when I touch my heart and I reflect on this entire kerfuffle that the world is currently in, where Europe is experiencing some sort of energy crisis, the US have some sort of runaway inflation problem, China has their own property crisis as well, and the rest of the ASEAN region is also inflating like no tomorrow because most of us are net exporters and importers as well. So when I really think of it from the perspective that, hey, China is really going to take over Taiwan one way or another, in one form or another, in time to come, I would fundamentally believe that the stock market has not come to a consensus on how severe and how dire the impact would be to the entire world, whether is it from supply chain, to demand destruction, to the sanctioning, and to warfare. I think nobody has a freaking clue. This whole idea of talking about, oh, the conflict is priced in, geopolitical risk is priced in, I strongly disagree. So I'll essentially open this topic up for debate. If you guys have any opposing view, please leave it in the comment section below. I would love to understand from a market consensus and sentiments perspective, whether you guys really believe that this China-Taiwan conflict is already priced in. Personally, I don't think so. So by this idea of being priced in means that if China were to really take over Taiwan, the share price probably wouldn't move as much. But I would say that if China really take over Taiwan today, within a snap of the fingers, I'm quite sure indexes are going to drop by at least 10-20%. So evidently, it probably wouldn't be priced in. So that's just my perspective. So I think just some parting thoughts, because I did talk about the EPS and why Alibaba experienced a peak EPS in December of 2019. I think firstly, the first main reason was the collapse in income was due to some impairment of the digital assets and also some crazy investment cycles. Because as we all know, I think back in early of 2021 to mid of 2021, they were investing heavily in many of their new initiatives like Taobao Deals, Taocai to essentially fend off competition like Pinduoduo and TikTok or ByteDance. So that was where a lot of their net income was being burned back into the business itself to try to build more modes, more product offerings, etc. And on the second part, from December 2021 to March 2022, the impairment of net income was mainly attributed to SunArt, which was a great acquisition they did back in 2020 or 2021. Similarly, again, investments in Taocai and Taobao Deals, and also a write-down of their market prices due to the different equity investments and the portfolio of companies Alibaba has. And I think some of them are publicly traded. So when the prices or essentially the valuations of these companies move, they have to write up and write down their net income, very much like Berkshire Hathaway and even Tencent. So that's just why the net income is experiencing this sort of huge fluctuations. So which is why, if you were to reflect back, based on some of the key consensus, based on estimates from analysts, etc. So they are expecting net income to normalize. So as you can see, this net income portion from 22 billion to 9 billion to 5 billion because this is last 12 months. And then 2023, 2024, projecting outwards, it will normalize back into 19 and 20 billion again. So that's why the forward PE is back to 10, 11, 12. Because I do understand that people are just going to go into Google and then Google Alibaba and find that, hey, why is the PE of Alibaba at 38 times? I thought everybody's saying that Alibaba is dirt cheap. So I'm actually interested to listen to your perspective on whether you think this entire cloud business is going to come into fruition, or basically you might think that all these Alibaba bulls are drunk. And so with that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye.